What's going on, everybody? Good morning and welcome back to Beat the Bell. Hope you guys are all having an awesome week. It is FOMC day, so it is a big day in the markets, and we are here to talk about it. We have a special guest with us. You guys know him, Matt from Rocket Scooter. Matt, what's going on?
Hey guys, how's it going? Thanks for having me.
All right, Diamond Trades, who is having technical difficulties, but is still going to be giving you guys your Fed forecast because he's the man. Diamond, good morning.
Good morning. No face, no case. I'm excited to get after it. Still have some great information to share with you guys.
All right, and Stock Snipa, who is live from Dubai this morning.
Good morning, guys. Yeah, this is a special episode about 12,000 miles away from home.
Still repping the King Cap hoodie. I love it. All right, let's go straight into Fed forecast with Diamond. Take it away.
Yeah, let's do it. Let's start with the economic calendar for today and this week. So today we're going to get new home sales at 10 o'clock. That is before the FOMC interest rate decision that'll come in at about 2. And then Powell's press conference at 2:30. We'll dive into that in just a little bit. But let's talk about this week's trading first. So the markets have been choppy but resilient to start the week as investors begin to digest the flurry of data that's headed their way. So the Nasdaq is up 0.75% since Monday's open, with the Dow and S&P more or less even at 0.45 and 0.43% respectively. The financial sector in particular, regional banks are one of the few lagging areas of the market on the back of the news that PacWest, one of the troubled banks in the March banking crisis, is going to be bought out by a rival Bank of California. The bank shares dropped more than 28% intraday yesterday at the lows before making a full recovery in after hours, despite releasing weaker than anticipated 2Q earnings. So both Bank of California and PacWest released earnings just hours after that announcement that there was going to be a takeover there. Very, very strange timing to sort of see that, and we'll have to watch the shares of both companies going forward to see how that plays out. Let's go ahead and dive into Microsoft earnings. So Microsoft reported earnings yesterday after the close, posting higher than anticipated revenues and profits. Revenues came in at about $56.2 billion versus $55.5 expected. EPS came in at about 2.69 per share versus 2.55 expected. Despite the double beat, shares dropped more than 4% in expected trading Tuesday night after the company called for lower revenue guidance than analysts were anticipating, largely due to their Windows segment, which they projected will do 12.5 to 12.9 billion in revenue next quarter, lower than the 13.22 billion analysts were looking for. Microsoft Azure, arguably Microsoft's most important business segment, showed revenue growth of 26% versus analyst expectations of 25%. For comparison, Google's comparable segment, Google's cloud segment, showed revenue growth of 28% rather, in the previous quarter. The news on the AI front for Microsoft, however, was all positive. CEO Satya Nadella shared that Microsoft's Azure OpenAI service that companies can use to access language models and other developer tools now has over 11,000 customers, up from 4,500 customers in May. So seeing good growth there on their OpenAI Azure service, and both the CEO and CFO said that they should expect that to impact revenues towards the second half of next year, the second half of 2024. Today, obviously the biggest news for today will be the Fed. So the FOMC will announce their interest rate decision today at 2 o'clock, which is widely expected to be another 25 basis point hike. That'll bring the target range for the federal funds rate to 5.25 to 5.5, the highest level in 22 years. With the rate decision all but baked in, investors will turn to whatever forward guidance Chairman Powell shares in his press conference, with some optimism that he'll hint that this is the last rate hike. Nick Tiramos from the Journal says that won't be an easy task for the committee given the level of growth in the economy so far this year. The economy has remained resilient with consumption levels elevated and labor markets tight. It's really all going to come down to what Powell has to say about where the Fed is planning on taking rates at their next meeting in September. They do not meet in August. They've got a hiatus, and then they come back in the middle of September 20th for their next meeting. So that's going to wrap it up for Fed forecast. That's what we'll be watching today for the FOMC meeting. And I'll pass it back to Alejandro.
Excuse me. Thank you. Going to take a second to look at the S&P 500 quickly before we move along. So coming into today, What has been most important, if you're trading using the system, we see that the 1 hour 50 SMA continues to hold and that we have been in an uptrend for multiple weeks now. Today, or this week in particular, and the end of last week, things were a bit choppier. And we've been talking about this on the previous episodes. After the S&P rallies 150 points directly up with virtually no pullbacks, what's going to happen next? The market either needs to pull back or it's going to simply base around and chop. And we've been getting the latter. The reason is July, seasonally strong month for stocks. We've been seeing these dips getting eaten up, but the difference is that there hasn't been much follow through. So the trading, you've had to be a little bit more pinpoint with entries and exits, understanding that the home run that we got for that 1.5 week period, once we broke over the July highs, that sort of trading was behind us for at least a little bit of time. And now we've been chopping, leading up into what has been what will be a massive catalyst for the markets in FOMC, and that is this afternoon. So hopefully we get some volatility and things can pick back up. But in general, still absolutely no reason to be bearish technically, as you guys can see that we are trading above the 1 hour 50 SMA. As long as that can hold, bulls remain in control through the end of July and into August. So that's something to watch for. Of course, the vice versa is true if we sell below that level, and we would likely run to back test where we got that giant breakout to start the month. All right, guys. So that's going to do it for the system. Now, going to pass it over to Matt. Matt, good morning, brother. Want to first ask you about Rocket Scooter. Well, first I want to ask you how you're doing because you haven't been on the show in quite a while. And then we could talk about some Rocket Scooter and what you're seeing in the market.
Sure thing. I'm doing great. Thanks for asking. I went on a couple trips last couple of weeks, so did watch from afar though. Yeah.
Nice.
So yeah, we're doing pretty good over at Rocket Scooter. Been of course showing our monthly maps, which is our feature that projects where risk and positions are into the future. And honestly, it's just showed a stable bull market. And a couple months ago, there was a huge pivot where we saw the market even extend out towards the middle of October to still show that growing bullish position and anticipation of the market just stabilizing. We are still bullish even through probably rate hikes today, probably through earnings, maybe not be as bad as people think. And the market is just healing itself. There's a lot of economic data that's coming through that's also showing good signs of recovery. So I'm pretty excited to see how we react to the FOMC decision this afternoon.
All right, so I'd like you to provide us with an update on the commitment of traders report. I know that that's something that you reference quite often. If
Absolutely.
you do have the ability to share your screen, feel free to do so.
Yeah, absolutely. Let me grab my COT report really quick. It's in here somewhere. Hold on one second. Oh, there it is. Okay. So let me make this full screen really quick. So on my screen, you can see commitment of traders. And so what we look at is the positional data. Commitment of traders, obviously, if you're not familiar with the report, it's a report that's updated once a week by reportable positions to the CFTC. It's broken into categories. We look at the TFF report, and this is dealers, asset managers, hedge funds. The green, blue, and red lines basically show spreading of positions. Since we, bottomed out in October, everyone can see the asset managers, which is your long part of the market. These are your 401ks and mutual funds and things. They don't really short. They just either long or go to cash. And the long part of the market has become more and more and more and more long. And this is S&P futures right now. So over the course of the year, the market's just rallying on genuine accumulation of longs. This is exactly what you're seeing. And one of the most interesting parts of this is that we've been accumulating on the short side of the market, which is the hedge funds, the blue line, a net short that is still trying to short, betting on a big fat market crash. And this short hasn't even started to unwind yet. People are incorrectly characterizing this rally as a short squeeze or a melt up. It's very obvious to see that this is genuine long buying. And there's a million explanations to why that is. For the most part, My belief is that nobody wants to miss out on a tech boom. Even if the utility of AI is not there, the utility of pets.com in 1998 wasn't there either, but yet companies traded infinity times over earnings because of the hope of not wanting to miss out on a tech bubble that ultimately was correct. The S&P over those 3-year period rose 300%. I mean, from 500 to like 1500. So the idea that whether even there's utility with AI or not, that's a huge debate. It doesn't matter. Nobody wants to miss out on a tech boom because those fund managers who are 50 now were 30 then, and they missed out on it and got laughed out of their office. So now they get their time to shine. They don't want to miss out. And so this is a genuine rally despite economic data and QT and all the other things that could be bad. The shorts haven't even begun to squeeze. This position is still heavily net negative. As a matter of fact, it's about as net negative as it was around the era of COVID. And so during COVID, you can see that whenever we sold off, the shorts were trying to short on round 2 of COVID. We're about negative 400,000 contracts right here. And the vaccine came out, and then we just rallied on the actual short squeeze. The short squeeze is when this blue line goes above 0. And as you see right here, even despite selling on the news of QT and selling on the announcement of future rate hikes, the market still rallied for 6 months on the short squeeze, which tailed at the end of the buying. So the buying just started. The short squeeze hasn't started yet. That's where my thesis comes in of that when people are saying this is a melt up. No, this is the start of a rally. If there's a melt up, a short squeeze that starts, it accelerates the move higher. So if whatever comes out starts to scare these shorts, it's about the same, about negative 350,000 contracts, very similar to that short in COVID. Look how it unwinds when the shorts finally get squeezed. This is not a gimmick. This is tried and true longing in the market. And so what I like to say is that when people are talking about a bubble forming, I don't disagree. And timing a bear market is everything. A bubble is formed by, it starts with the simmer, it starts with a wobble in the water, then it simmers, and then it boils, and then it boils over. We just started wobbling in the water. This is not even the end of a bubble. The S&P, like I said, in the last tech bubble, tripled before it popped. So we're still starting. We haven't even broken all-time highs yet, and people are still calling for the sky to fall. There are no short squeezes happening that's causing this rally. So if a short squeeze happens, it accelerates very rapidly. So that's what we're staring at the commitment traders. If I can pivot over to Rocket Scooter really quick, just one more question, or on the same question, you can see, and I'm just not going to explain all of this, but on the monthly maps, if you trace where my mouse is, where this gray line is, it shows that the bullish positions are getting deeper and deeper in the money as time goes by, and that the bearish positions are getting deeper and deeper out of the money as time goes by. This is evidence that the short is about to get squeezed as the bears are unwinding over the course of the next 3 months. So that short position, the commitment of traders, is slated to squeeze over the next 3 months. And in my opinion, this rally is going to accelerate starting next week. So that's what we got.
I love it. And you've been pretty spot on, up to this point. We've been checking in on not only the commitment of traders, but on the Rocket Scooter liquidity maps all summer long. And I mean, we continue to rally. So the proof is in the pudding, as they say.
Hope so. I mean, there's not really a lot of bad news coming down the pipeline. There's just a lot of, I guess, you would say that people, QT is off. We rode a huge rally off of QE, and now we're in QT. It's going to be, it's like we all see it. Everybody sees it. It's not this, same as it was in the 2010s. Obviously, it's not going to be Fed printing money like it used to be. But it's kind of like you have to think about it like this. There's my favorite saying in the world is you never underestimate bullish stupidity. Markets will rally stupidly as people don't want to miss out, and people will get in and climb over each other despite the writing on the wall, just because they don't want to miss out. And the goal of a trader is to see that. And right now we're in a period of people realizing they don't want to miss out. And I'm not going to sit here and doubt a rally as it goes up, because I can see everybody trying to jump in on tech as fast as they can. And every dip's going to get bought up. So it's not my job to guess when that stops. I'm just use Rocket Scooter and, of course, commitment traders report to watch when it stops. It's going to literally tell me when it's over, and then I'll be the first bear of the party, right? Timing's everything.
I love it. All right. Awesome stuff, Matt. I appreciate you sharing
Thanks,
that
bud.
with us. All right, guys, we're going to go over to Stock Snipa now for Bet the Bell.
What's up, guys? It's time for the best part of the show. So I'm going to have to start it off with our normal, typical question once we see these standings right here, which, again, can't guarantee the accuracy of these standings. But first question of the day, green or red? I'm going to have to start this one off with Honda.
I'm going to go with green.
Green.
Today's
Okay.
as 50-50 as it gets with FOMC, for being
It's
honest.
literally a coin flip, man.
Probably less than a coin flip.
Matt, what do you got? Green or red?
Green. I'll take Hondo's side.
Okay. Diamond, what you got?
I'm gonna go green as well.
Okay, I like it. Green across the board. But I'm going to be the one who picks red. So if it is red, I'm the only one who's right. I'm going to go ahead and dive into the next question that I got, which is a pretty interesting question. Apple is releasing a VR headset, and it looks like a lot of people are pre-ordering it. A lot of interest in this one. And we all know Meta has a headset called Quest 3. These are both targeted towards that virtual reality space. My question for you guys is, which one will prevail? Who's going to dominate the industry? Diamond, I'm going to have to start this one off with you.
It's tough. I will go with Meta. I'm gonna go with Meta. They had a head start, and they've been they poured a bunch of R&D into this space already, albeit with not necessarily the results that people were hoping. But I think that if you're putting the two head to head, Meta's definitely got the experience, at least in this sort of arena. I know that anytime that Apple puts something out, it becomes the hot new thing. So we'll have to see there, but I'm going to go with Meta for this one.
Okay, I like it. Hondo, what you got? Apple or Meta?
All right, so I am going to go with Meta. The reason is it seems like Apple is more geared towards AR, augmented reality, and the new headset is more focused on that. Quite honestly, I don't think that the VR space is going to catch much fire at all. I mean, at least thinking about me, like how long has this Meta headset been out for? And I haven't even tried it. It hasn't really interested me. But yeah, I think that what Apple's building, the applications are much more. It's a bit more realistic, I think, for people to be using this. Especially, I saw they were, when they first promoted it or premiered, they were showing people working in offices using it in order to complete, everyday work tasks, stuff like that. I think is important versus the Meta thing. Just kind of seems like, I don't know, the whole metaverse. I'm still not on board, but I mean, if we're talking about VR, I guess Meta's leading the way. and will probably continue to lead the way, while Apple does the smart things and focuses more on AR.
Interesting. I like that take right there. Matt, I'm going to have to ask you, Meta or Apple?
I have a similar response to Alejandro. Now, as a child of the 80s, I know VR comes around every 10 years, just like swing music does. It's like it resurfaces, everyone gets excited about it. You got to put on this big clunky headset and the gimmick goes away. I mean, I got an Oculus sitting in there, so I can play Beat Saber, but I really don't ever touch it, like every once in a while. Until you get a headset that doesn't feel like a head. Like if this was my headset, these glasses right here, that's when VR is going to take off. No, nobody wants to put on big clunky headsets. So it's kind of like which one of the two companies is going to walk faster. And I'd have to say Meta. This is not going to be a sprint yet until the technology is like it's in a contact or something that it interacts. It doesn't like take up your space, right? And just because it's tried and true, I agree with what Alejandro said is that Meta they have a lot of experience. The Oculus has it's really good. It's actually probably the best one there is, but it's still a big clunky box that sits on your eyes, and it's weird because when you play games like that, you sweat into it, and you have to clean the glasses and stuff. It's just not going to be something I'm going to wear when I'm grocery shopping. You know what I'm saying? So. At this point in time, I have to go with Meta for now, but I think down the road, I think Apple has the ingenuity to create something that interacts with your body and is an extension of yourself, which is the vision of what Apple's always been about. So later, 10 years from now, Apple, but for the next 10 years, probably Meta.
I like that. To be honest, the Apple headset is selling at 800% as much as the Meta headset, if I'm not mistaken. For some reason, I feel like Apple has some kind of features that Meta doesn't include. But again, Meta does have a year-plus head start on this space. So yeah, I'm gonna have to go with Apple. I'm gonna have to go with Meta, excuse me. But I think that Apple will definitely take away from Meta's clientele. I'm gonna go ahead and jump over towards the next question, and this is an interesting one. JP Morgan Would you rather own $750,000 worth of Bank of America shares, or would you rather own $1 million worth of JP Morgan shares? Now, let me introduce one catalyst to you guys in case if you're not aware of this. There's a $160 million lawsuit currently going on with JP Morgan right now. They are suing the Virgin Islands. It involves the Jeffrey Epstein case. Not 100% sure of every little detail about that, but very big catalyst if they end up winning $160 million. I'm going to start this one off with Matt. Would you rather own $750,000 worth of Bank of America or $1 million worth of JP Morgan?
I have to say, just on the technicals alone, I would buy Bank of America, being obviously not JP Morgan's are almost trading at highs right now. So I take the smaller position in Bank of America despite the lawsuit, just because it has more room to move to achieve all-time highs. So that 750 would appreciate
Important
more.
note, Matt. The holding period when we do these questions, you have to hold for a year.
Yeah,
Yep.
perfect. Bank of America it is. Let's do it for a whole year.
Diamond, I'm going to jump to you next. $750,000 with the Bank of America or $1 million with the JP Morgan?
I'm gonna go with JP Morgan. I know that my answer to these questions is often disappointing. I try and go with what I deem to be the safer of the two, especially since you have to hold for a year. You don't know what could happen in between. JP Morgan's cream of the crop, so I'm gonna go with them.
I like it. Hondo, what you got?
I agree. I'm going JP Morgan. They've had a really strong year. And JP Morgan over the last decade has outperformed Bank of America. So if I have to hold another year, I would definitely be interested in holding JPM over BAC.
I'm going to have to take the $1 million worth of Bank of America. $1 million worth of JP Morgan. Especially with that catalyst, which I think things could be pretty optimistic for them with their Virgin Islands lawsuit. I'm going to go ahead and jump over towards the next question, which is the $1 million question, the question of the day, what all of you guys want to hear. What are your Fed predictions? If I'm not mistaken, I think we are expecting 25 BPS, but I'm going to have to start this one off with Diamond.
Yeah, I mean, it's a 98% chance of I think it's actually higher than that. I think it's 99.8% chance of a 25 basis point hike. It's basically what Powell said that they would do. Powell rarely lies. He may be a bit ambiguous, but he rarely lies. So I'm going to go with the 25 bips.
Okay. Hondo, what you got?
Yeah, I'm going to go with the 25. As you said, it's like 98%, 99% even priced in. So shouldn't be too many surprises there. I guess the speech would be most important. And these FOMCs, they, at least from what we've seen so far this year, they don't hold the same weight that they did in 2022. I think that everybody, freaks out a little bit too much going into these, and I could see it being a pretty muted day, quite honestly.
Okay. Matt, what you got?
I don't disagree. I mean, even if you think about it, it's practically already priced in. I mean, the strong rally that we've seen has started to slow down as people are anticipating a rate hike. As you know, if we knew we were going to still be floating on no rate hikes, people would have been a little bit more aggressive in the market. So even the flattening of the S&P on top of the Fed funds futures, showing like 98% chance of a 25 BIP hike. Even the stock market says that. It's almost obvious that's going to happen. So I think we're going to have that and probably a muted response to that. I think the S&P is going to probably go up, go down, and then stay where it was. So flat day and
agreed. Lots of up, lots of down, trap a lot of people, and then just finish flat.
Yeah, drop down, trade right back to normal, and then slightly green because I was a green prediction today, right? Green day, so maybe 1 point green.
Exactly. There's a little bit green.
A little bit.
All right. That's going to do it, guys, for this morning show. Beat the Bell. Appreciate you guys joining us. Matt, thank you for hopping on. We'll be trading live today in the Kane Capital Discord. You guys can go to kane-capital.com or scan the QR that should be popping up on the screen any second. Have a great rest of your days, guys, and we will see you back here on Friday morning at 8:30 a.m. Eastern Time. Have a good one, everybody.